It's Saturday, January 31st, 2026. The number is 25%. That is the tariff level the White House just threatened for South Korean imports. Reuters reported President Trump said he is raising tariffs to 25%. He named autos, lumber, and pharmaceuticals. He also referenced broader, reciprocal tariffs. Here's the promise. By the end, you'll know the mechanism chain. You'll know why FX moves before earnings. And you'll have 3 screens to track this week. This looks like a simple trade headline. The mechanism is a pricing shock with a clock. Start with the timeline. Reuters said Trump pointed to a deal reached last year. He said South Korea's legislature has not enacted it. So he would lift the tariff rate from 15% to 25%. 15% was the truce price. 25% is the pressure price. Receipt moment 1 is the exact line. Reuters quoted Trump's post. I am hereby increasing those tariffs from 15% to 25%. That line matters because it is the rule change. It turns a negotiation into a repricing event. Now ask the real question. Who eats the wedge? A tariff is a wedge between 2 prices. The price a U.S. buyer pays and the price a Korean exporter receives. Somebody absorbs the gap. If exporters absorb it, margins compress. If importers absorb it, consumer prices rise. If both share it, volumes can still fall. Markets guess the split on day 1. That is why you see quick moves. FX gets pulled in first because it is the pressure valve. If the one weakens, it offsets part of the tariff in dollar terms. If the one strengthens, the tariff bite gets worse. So, the first market to react is often USD to KRW. But that is only the first layer. There is a second layer that markets treat as higher signal: credibility. Reuters reported U.S. Trade Representative Jamieson Greer said tariffs had been cut to 15%. That cut was tied to commitments. One headline item was a South Korean pledge to invest $350 billion in the U.S. Greer said Korea had not passed the needed legislation. He also pointed to unresolved barriers in agriculture, industry, and digital services. He called the trade deficit gap unsustainable. That is the credibility wedge. Receipt moment 2 is that framing. A cut to 15% was conditional. The threat back to 25% is the enforcement lever. This is why deal delay matters more than tariff talk. A delay means the rule set is unstable, and unstable rules force companies to hedge. When credibility gets questioned, the risk premium rises. Orders get delayed, capex gets paused, hiring plans get pushed out. That is how a tariff headline becomes a growth variable. Now, plug in autos because autos are the cleanest channel. They are big ticket goods. They are high visibility. And they sit inside long supply chains. A 10-point tariff jump is not small. It hits sticker prices or profits. Sometimes both. If sticker prices rise, demand shifts. If profits compress, guidance drops. Either path tightens financial conditions. It also hits suppliers. More cost pressure means more renegotiation. It means more inventory caution. And it can mean more layoffs at the margin. Now add the part that makes this story market first. Tariffs do not need to be implemented to move prices. Threats move markets because uncertainty is a tax. It widens the range of outcomes. That range shows up in implied volatility. And it tends to show up in FX first. Here is how it becomes macro. A tariff threat can act like a goods inflation shock. If pass-through looks likely, inflation expectations lift. If expectations lift, yields lift. Higher yields tighten conditions for households and firms. Then credit spreads can drift wider with a lag. None of that is automatic, but it is a practical path. This is also a supply chain story. South Korea is wired into chips, batteries, and autos. If demand gets pulled forward or pushed back, logistics react. It shows up in shipping schedules and inventories. That is why trade stories spill into inflation later. There is also a template risk. If tariffs become the default enforcement tool, uncertainty rises globally. That tends to lift the dollar and stress regimes. It also tends to lift volatility across markets. Reuters also reported Trump later said, "We'll work something out with South Korea." That line matters. It keeps the door open for a pause, but it also keeps the clock running. Markets hate open clocks. There is a political clock in Seoul too. Reuters said South Korea's parliament was expected to consider related bills in February. Legislation is the receipt the U.S. says it wants. No bill, no credibility. No credibility, higher tariff risk. And Reuters reported talks happened without an immediate agreement after the threat. That does not prove failure. It proves the uncertainty is still live. So here is the chain in plain English. The U.S. signals 25% tariffs instead of 15%. Companies reprice cash flows and hedge fast. FX moves first because it is the quickest hedge. Autos reprice on margin and volume risk. Then inflation expectations and rates adjust if it persists. Credit follows if tighter conditions stick. You can usually see the cross-asset order. FX reacts first, often within minutes. Then autos and exporters move on the headline. Rates move if the market believes prices will follow. Credit moves last unless funding stress appears. In this case, the early reaction was concentrated. South Korean automaker shares dipped after the post. That is consistent with margin risk repricing. The won also became more sensitive to headlines, and broader volatility gauges ticked up in parallel. That is the market widening the cone of outcomes. If the reaction looks muted on a given day, that is not comfort. It can mean investors are waiting for receipts. It can mean they expect a negotiated pause. Or it can mean the risk is being warehoused quietly in FX options. That is why the next week matters. This story turns on paperwork, not vibes. A formal notice, a legislative vote, or a signed pause. Those are the things that collapse the uncertainty premium. This is not guaranteed doom. It is a probability shift. It is a wider distribution. And markets price distributions, not certainties. Make the mechanism concrete. Imagine a U.S. dealer ordering Korean cars. Under a 15% tariff, the math is painful but manageable. At 25%, the math changes. Either the dealer raises prices, or the manufacturer offers bigger incentives, or the dealer takes less margin, or volumes slow. Those are the only levers. Markets care because each lever hits a different asset. Higher prices push inflation expectations up. Lower margins hit equities. Lower volumes hit growth and credit. More incentives can squeeze suppliers. And FX sits in the middle of all of it. That is why USD KRW matters more than a stock candle. Currencies are where hedges go first. A U.S. importer can hedge KRW exposure quickly. A Korean exporter can hedge USD receipts quickly. Those hedges become flows. Flows move spot. Spot moves psychology. Then psychology moves the headline. There is also a political economy layer. If the won weakens on tariff risk, imports get pricier in Korea. That can raise domestic inflation pressure, it can complicate the Bank of Korea's job, and it can force tighter financial conditions at home. So, a U.S. tariff threat can tighten Korea twice, once through export demand, once through domestic prices. Now, zoom out to trade balance logic. The U.S. is saying the deficit is too large. The tool is tariffs. That tool does not fix a deficit overnight. It changes prices and incentives over time. In the short run, it mostly adds uncertainty. Uncertainty is the hidden transmission channel. It makes firms hold more inventory. It makes them delay hiring. It makes them postpone investment. Those choices reduce growth at the margin. They also change inflation at the margin, because less investment can mean less future supply. This is where people get the story wrong. They think tariffs are only inflationary. Tariffs can be inflationary in prices. They can also be disinflationary in demand. The balance depends on how much demand falls and how fast supply chains adapt. So, the real question is speed. How fast do firms adjust sourcing? How fast do they adjust pricing? How fast do consumers adjust behavior? Markets try to price that speed. Now, bring in the specific categories. Autos are visible. Lumber matters for construction inputs. Pharma matters because it touches health costs. And reciprocal tariffs matters because it is open-ended. Open-ended is what creates fat tails. Fat tails are why FX option via all matters. If the policy path is uncertain, options get bid. That is the market buying time. Now, what does this mean for the U.S. consumer? Not in theory, in the near term. If tariffs actually rise and stick, the first impact is on prices of affected goods. That can show up in dealer incentives and model availability. It can show up as longer wait times for certain trims. Or it can show up as higher monthly payments, because even a small price move gets amplified by financing. If tariffs do not stick, you still get a hit. The hit is in planning. Firms price in the risk, they build cushions. Cushions cost money. This is why markets move on threats. The cost starts before the policy starts. Now, look at the cross-market spillover. If investors think tariffs will raise inflation, break-even inflation moves up. If break-evens move up, real yields can move too. Then the dollar can firm. A firmer dollar can tighten global conditions. That matters for emerging markets. It matters for commodities. And it matters for risk appetite. But if investors think tariffs will hit growth harder, yields can fall, equities can wobble on earnings risk, and credit spreads can widen if refinancing looks tougher. Same headline, different path. That is why you need receipts. So, what counts as a receipt this week? A signed pause, a published notice, a legislative vote, or a clear statement from negotiators. Absent that, the market defaults to probability. And probability is a moving target. Translate this into one clean risk frame. A practical risk is that the tariff threat becomes a baseline. If it becomes baseline, firms reprice supply chains. That repricing is slow, and slow repricing means prolonged uncertainty. Prolonged uncertainty is what grinds growth. Another practical risk is second-order retaliation. Not necessarily loud retaliation. Quiet barriers, slower approvals, new compliance steps. Those are hard to headline, but they can move margins. If that happens, you would expect FX volatility to stay elevated. You would expect exporters to lag, and you would expect inflation expectations to drift. Again, not guaranteed, but that is the path. Now we come to the three signals. These are your clean markers. No guesswork, no social media noise. Signal 1 is USD/KRW spot plus 1 week implied volatility. Where to look is any major FX platform. If USD/KRW holds higher for 3 sessions, the market is stressed. If 1 week implied VOL rises and stays bid, uncertainty is persisting. Typical lag is hours to 1 day. Signal 2 is South Korean auto equities versus the broader KOSPI. Where to look is the relative performance chart. If auto names underperform for a week, margin risk is sticking. If they bounce while FX stays stressed, it suggests hedging is the main driver. Typical lag is 1 to 3 sessions. Signal 3 is US 5-year break-even inflation. Where to look is the break-even curve on major market terminals. If 5-year break-evens grind higher after tariff headlines, pass-through is being priced. If they fade while FX stays hot, the market sees it as negotiation noise. Typical lag is 1 to 5 sessions. That's the clean check. Those 3 lines tell you what the market believes. Now, the catalyst window. The next 72 hours are about receipts. A formal U.S. notice would harden the path. A clear Korean legislative move would soften it. A joint statement would collapse uncertainty fastest. Over the next week, expect the story to move in bursts. Tariff headlines often land after hours. FX reacts first. Equities gap next. Rates follow when the narrative becomes inflation or growth. Keep the lens calm. This is not a forecast. It is a mechanism map. If the receipts point to a pause, the risk premium can unwind. If the receipts point to escalation, the risk premium can compound. And if receipts stay missing, the market can chop in a wide range. Now, pull it together. A tariff threat is not just a headline. It is a price wedge with a countdown. When the number jumps from 15% to 25%, the split matters. Either prices rise, margins fall, or volumes slow. Usually you get some of all 3. The early market tells you where the stress is. FX moves first because hedges move first. Equities reprice as margin math updates. Rates react when inflation expectations move. Credit reacts last unless funding stress appears. The key is credibility. Reuters reported the U.S. framed the 15% rate as conditional. It was tied to commitments and legislation. Now the threat is a return to 25% as an enforcement lever. That is why the premium shows up before the policy. So the risk is not one-day volatility. The risk is a longer period of unstable rules. Unstable rules slow trade and investment. They also raise the chance of second-order barriers. Those barriers are quiet, but expensive. What would change the story fast is a receipt, a written pause, a published notice, or a legislative vote. Those are the events that compress uncertainty. Absent that, The market keeps repricing probabilities. Keep the frame neutral. A reasonable read is that this is leverage, but leverage still has a cost while it runs. If it drags on, that cost becomes the story. Here is the real economy spillover. If autos get pricier, monthly payments rise. That is not abstract. It hits credit decisions at the dealership. It also hits used car pricing because substitutes tighten. For Korean exporters, a weaker won can cushion revenue, but it can also raise local import costs. If that pressure builds, it can bleed into domestic policy choices. That is why this story can touch both sides of the Pacific. For the broader market, the bigger issue is uncertainty. Uncertainty forces higher buffers, more inventory, more hedging, more caution. Those buffers show up as slower growth later. Over the next week, the path is binary but messy. A pause can unwind the premium quickly. An escalation can extend it and broaden it. A long silence can keep it grinding with headline spikes. Keep the intensity calibrated. This is not a guarantee of higher inflation. It is not a guarantee of a growth hit either. It is a risk distribution that just widened. One more nuance. Even if spot FX looks calm, options can stay tense. That is the market paying for protection. If that premium stays elevated, it tells you positioning is cautious. And cautious positioning can amplify moves when the next headline hits. Now, repeat the clean signal check. Exactly 3 markers. Same 3 every time. Signal 1 is USD KRW spot plus 1 week implied volatility. If USD KRW holds higher for 3 sessions, stress is sticking. If 1 week implied VOL stays bid, uncertainty is persisting. Lag is hours to 1 day. Signal 2 is South Korean auto equities versus the broader KOSPI. If auto names underperform for a week, margin risk is sticking. If they bounce while FX stays stressed, hedging is the driver. Lag is 1 to 3 sessions. Signal 3 is US, 5-year break-even inflation. If 5-year break-evens grind higher after tariff headlines, pass-through is priced. If they fade while FX stays hot, it is negotiation noise. Lag is 1 to 5 sessions. That's the mechanism. That's the cross-market map. And that's how you avoid the wrong story. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.